So hello, this is Perry Mehrling, the professor of the Money and Banking class, and I'm here with one, two, three, four, five, six students from the class, and we're having our first hangout. I had invited several more, but I think maybe they're having difficulty getting on. We don't know quite what we're doing, so if you'll bear with us. There's also a chat feature, which you should be able to see if you're viewing this on YouTube, and you can ask questions, which I'll see and I might be able to answer. The six of us, seven of us, including me, have just been getting acquainted in the last half an hour. And so I can tell you that we have people from all over the world. We have lawyers, we have economists, we have even a professor, and aspiring professors. So it's a good cross range of people. And I think while those of you who are watching this are preparing your questions, I'll just ask if they have any questions for me. And who wants to start? Mihail.
Okay, I'll start because I joined first. I have a question concerning the dealer function of the banks. In fact, I think the whole course is explaining that this is one of the points of view at the banks, that they are not just intermediaries, or probably they're not intermediaries at all, but they are rather dealers on the money markets. And as I understand it, they are dealers between the public money and the private money. But in the last lecture, Professor, you said that the banks in the peripheral countries in Europe, they're having a funding problem because depositors are withdrawing their deposits and putting them in the core countries. And to me, there is a little, I find a little bit of conflict with the idea that banks are dealers, because this somehow suggests that in a way they are intermediaries. Intermediaries, they are funded by deposits, which are their liabilities, but if these liabilities are withdrawn and put in banks in the core countries, they are losing funding. So of course, they probably have to transfer part of their reserves as well, and that perhaps depletes their. Yeah. But yeah, that's the question.
So this is a big, challenging question just to start with. We don't start with any easy ones. You will see, actually, this coming week, I'm going to develop more this idea of banks as dealers. And one of the features that I will emphasize is that banks have a particular challenge in being dealers because they can't change the price. Okay, that is to say the parity between, so they don't, as opposed to a dealer in Apple stock, right? If all the pressure is on the buy side, they just raise the price. Okay, if all the pressure is on the sell side, they just lower the price. Banks can't do this, okay, and so that causes trouble, and that is where central banks come in, and so forth. So I'm going to maybe postpone that a little bit and just say that you have put your finger on a particular issue that we need some more background to talk about, and it is a vital question, in fact. But I will just say one more thing about this. This idea of thinking of banks as dealers is not a common one. Okay, it's not typical in money and banking really at all. And it is, I think it's my invention maybe, but it comes from, it's my way of trying to link up the money market activity with capital market activity and linking up money with finance. Okay, those have been very separate subjects in the last 50 years in economics, with completely separate professional training and separate tools. And I don't see why they should be. Particularly since shadow banking is money market funding of capital market lending. the world has joined these subjects, and so we have to as well. And so this idea of thinking of banks as dealers is an attempt to create that link. In the past, thinking of banks as intermediaries was in fact an attempt to do that as well. Okay, we will see when we do Gurley and Shaw in part two that thinking of banks as similar to insurance companies or something like that was a big advance. As a matter of fact, in that they are just a financial intermediary, just like other financial intermediaries. That was a big advance. So, but it's not enough of an advance for now. We need to go. We need to go farther, is my view. Who else? I can see you all, and no one seems to be jumping for questions. Anne, you're just about to ask something.
Sure. Let me. This, I hope this is within our scope. Leaving aside, just for the moment, the idea of elasticity and discipline, we know that banks began turning to funding in the repo market rather than turning to savings, which they did pretty much between the 30s and the 50s with the Glass, with all the regulations from the Glass-Steagall Act. My question is that because they're turning to this other kind of funding in the repo market, many of them relied on other kinds of security instruments rather than treasuries. For example, the residential mortgage-backed security and asset-backed security and corporate paper and this sort of thing. And so because there was this significant increase in other forms of security, primarily created by the shadow banking industry, I'd be interested to hear what you had to say, how that might have impacted monetary policy and interest rates, particularly in regard to the resulting increase in excess securities and, of course, a massive increase in the money supply at the bottom of the hierarchy.
Yeah. So you're talking about the shift, what I call the shift from a bank loan-based credit system to a capital market-based credit system.
Yes.
This is part of what you're talking about here, and so even banks are participating in that. You emphasize they're relying much more on, let's say, wholesale money market funding, okay, instead of deposits which are kind of sticky, and they don't, people don't move their deposit accounts from one bank to another, but they can absolutely not roll over their repo when it comes due one day. So it's less sticky, this form of funding, and it causes more fragility in a way because of that. That is a challenge for the regulatory authorities. You particularly raise the question of monetary policy. The story that most money and banking textbooks tell about monetary policy involves things like the money multiplier, involves things like where there's some change in interest rates that is causing people to want to invest more and they borrow. I think it really is a question about really is a question about the monetary transmission mechanism in the modern economy. That it has, it's changed. It's certainly not what it was before, and we're trying to find out how to make it work. So I always say I think we're living in a Bagehot moment, like 1873, where we know we're in a new world. We know how to put a floor on it, lender of last resort, okay, but we don't know much else. Okay, so how to manipulate interest rates, or what are the right tools to use for stabilization policy? I think we're in an exploratory time, and that makes this a very interesting time to be studying money, because it's not clear how much is going to survive from the things that we thought were completely true 50 years ago, because the system is different.
Do you think that much of what we're experiencing now is very similar to what we experienced during the Great Depression, say from 1930 to about 33? The reason I ask is that, glass of course, focused in on the securities and tried to limit the types of securities that banks could engage in, and then, of course, ring-fenced the ability of banks to engage in certain kinds of securities in an effort to control this massive increase in securities. Of course, because they also believed at the time that it was resulting in a massive increase in the money supply.
Mm-hmm.
So, can you respond to that?
Well, and we actually have other legal expertise here on the Hangout. We could get some other views on this. The Glass-Steagall, which just so everyone else knows, tried to draw a separation, okay, between capital markets and banks. And a legal separation, and they had to happen in different organizations. This was based on a theory at the time of what had caused the collapse, the notion that somehow the banking system had collapsed because they were holding these securities. I'm personally not sure that that's a correct theory. It seems to me that the Depression had a great deal to do with the collapse of the international monetary system. At the time, that the transition from a pound sterling based international monetary system to a dollar based international monetary system didn't happen when it needed to happen, and so we were left in a bit of a limbo, and it didn't really work. It was a fragile system. So I watch, in terms of the analogy between today and the Great Depression, I watch the international monetary system right now. And that's what all of my work is. My next book is about the international monetary system. And I've just been in China talking about the future of the renminbi and so forth. So the role of the dollar in the international funding system is, I think, the key thing to watch to see that. I think shadow banking is here to stay. Okay, in the sense of the connection between capital markets and money markets. I don't think, you could pass Glass-Steagall again if you wanted to, but it just means it's going to go offshore somewhere. So I think we need to learn to live with this system and figure out where its vulnerabilities are and how to manage it. So that's my view on that. Let's keep moving. Who else?
Well, a follow-up to that. So do
Patty.
you think that we're kind of moving away from the dollar as the main system?
No. I is the short answer. I feel that the dollar system is strong and robust, I believe, but it is evolving and it is developing connections to the other major currencies. We're going to talk more about this in part 2, but I will just say that there are swap lines between the major 6 central banks at the moment. That is to say, the Fed, the European Central Bank, the Bank of England, the Swiss National Bank, the Bank of Japan, and the Bank of Canada, and they unlimited permanent swap lines. Okay, so we have it, but the important thing is that the dollar is still at the center of this. It's not as if we are having 6 currencies that are equal. No, it's what we are having is a backstop of the dollar system at the very top with the top central banks. Probably no other countries will be added to this, okay, but they will have bilateral swaps. Those central banks will have bilateral swaps with one of the C6, and it's a hierarchical system at the international level. The Fed does not want to be the world lender of last resort. This is the point. It is not going to be the world lender of last resort. The other central banks, therefore, have to. It's going to be a cooperative enterprise among these 6 major central banks. I will have to defer more on that until we do international money, which we will do in part 2.
Thank you.
Anyone else want to chime in here? We're about halfway through. Elham.
Can I ask one question, Perry, about these international swap lines? So I was thinking about this issue, and don't you think that it's going to make a problem for other countries which do not have access to these unlimited swap lines? So all I'm trying to say is that it is another hierarchy now. First it was Fed, and all other central banks had the same issue when they wanted to ask for dollar from Fed. But now it's like the other five other central banks, it's easier for them to get funding when there's a trouble. But other central banks, which is like mostly emerging countries, they're gonna have much more trouble than before to have
Yes.
access to Fed, because
Yeah.
they have to go through to, yeah.
I'm going to link this to a question that's just come through from people watching from Nick Genserich. He says, "Can you please comment the Chinese initiative to create central bank for Southeast Asia?" So that's a similar sort of question to yours, and the I think we are building a network, and it is a hierarchical system. That's right, and it's not going to be equal. Absolutely not going to be equal. There will be people in the second level, like there are swap lines between the Fed and Mexico and other countries are nearby, for example. So they're nearer the top because they happen to be neighbors of the U.S. that the U.S. is concerned about. The Bank of Japan has swap lines with China. The Bank of England has swap lines with China. The Fed does not have swap lines with China. And if you don't have a swap line with one of the big six, you are a bit in the cold, okay, as you say. But then there's the IMF, okay? The IMF is sort of the public, last resort for everybody else. And it comes with conditionality and everything that we know. So it is a hierarchical system. It looks like there's emerging also some regional systems, and this goes to the question that was just asked about China. The Chiang Mai initiative, okay, was the beginning of trying to create a sort of Asian IMF, but it would be just for it would be a sort of China-Japan kind of operation there. That may or may not. It hasn't really turned out to be much at the moment, but China is very committed to internationalization of the renminbi, and I think there may be some regeneration of life in Chiang Mai that comes with that. Similarly, you could think of the European monetary system as a regional regional support network that is below the top of the hierarchy, but the relationship between the peripheral countries in Europe and the ECB. Okay, the ECB, the LTROs, that Draghi is doing to support this is a hierarchical system, right? That it's pretty clear that the central banks of Spain and Portugal and Greece are farther down, okay, than the ECB. So yes, it's a hierarchical system. I think that is the way it's going to be, and it's not going to become flat at all. I'm just looking at some of the other questions here.
Meanwhile,
yes,
can
go
I
ahead.
have
Yes,
a
go
question?
ahead.
Yes. Actually, this question is, I don't know whether it makes sense or not. It's about forecasting history. Let's assume that, let's just for the sake of argument, assume that Fed believed in Minsky, and they were Minsky. So what could they offer to ease the bottleneck in the economy in terms of constraints to prevent crises like 2008? Whether they could provide some elasticity so that we have had some upward movement in the asset sector, in the capital market. So I'm just trying to find my way around this issue. What could they have done about it?
So you're asking, what if the Fed had believed in Minsky? What would they have been able to do? I think not just the Fed, but really all central bankers have their maybe they don't have a fully worked out theoretical view of the world, but they definitely have a view that there's something about credit that is inherently unstable, the inherent instability of credit, because they experience it. They live in this world, and so they embrace Minsky. They embrace the worldview of Minsky. Stability is destabilizing, and they try to find ways to put a floor on it. One of the most recent talks I gave, one of the most recent papers I've given, I call Reimagining Central Banking. and it comes from the crisis, that we have learned from the crisis how to put a floor under modern crises. Okay, this is dealer of last resort. This is what my last book was about. But that's just the beginning, because you want to prevent these crises from happening in the first place. Okay, as you say, and so we need an analog to the leaning against the wind feature, okay, that used to be, well, we can just raise interest rates or something, and somehow that slows the economy down. It was always a problem. It was, it was that if in a real boom you raise interest rates, it can be stoking the fire. It attracts more money into the system. So it's always been difficult to put bounds on the system, and that's just as true today. We have the two big challenges, that all central bankers realize we face, okay, is the rise of market-based credit, okay, capital market-based credit. Very different from bank loans. You can put a lot of pressure on banks in various ways. It's less easy to put pressure on capital markets. But the second thing that I would emphasize, and that links to what we were doing before, I would emphasize the international character of the modern system, that funding markets are global, so that an individual central bank cannot really operate on their own. They need to be operating in concert with other central banks. These are big challenges, and I don't have answers for them. But that's what we are trying to sort out. That's what all central bankers are trying to sort out at this moment in history. That's exactly the right question that you asked.
Thank you.
I see that we've been joined by a few more people. We're learning how to make this Google Hangout work, so it's a learning experience for me. So we are now at 22 minutes past, and I promised you that it wouldn't go more than 30 minutes. Who wants to go next? Caroline, how about you? You've been very active on the.
I have a question.
Yeah.
It's related. Yeah, so it's related to dealers as liquidity providers, and I understand how banks can provide liquidity, but that seems to me to be tied to the fact that they are trading at par, and when the dealers are able to change prices, it seems to me that especially when we have dealers who mark to market their balance sheets, you get into this situation where the dealers themselves don't want to catch a falling knife, and so they themselves actually are not necessarily very good sources of liquidity, because they're not going to jump into the market when they expect market prices to fall. They don't want to be caught holding the asset with a falling price, so their prices themselves drop very dramatically. And I guess because of their ability to change prices, it seems to me that frequently they aren't liquidity providers, and I guess that's kind of what I'm wondering. Like, I understand how banks provide liquidity, but I think the reason they're able to do so is because of their being tied to par, whereas dealers, financial market dealers, kind of don't have the same situation. So I'm wondering how that works.
The argument that I will be making in basically the lectures of next week that will be going live on Monday. Can you hear me? Did I drop out here?
We can hear you.
I don't know what happened to my video, but the argument I'll be making is almost exactly the opposite of that, because I'm going to be trying to view banks as a special kind of dealer who are in fact constrained by par, that because they can't move their price, they're actually more vulnerable than regular old dealers. Now, it's the key to getting into your question, I think, is really being very clear about what we mean by liquidity. Okay. Very often the word liquidity is used in multiple ways, and people wind up thinking they're talking to each other when in fact they're talking past one another. Liquidity is used as even a synonym for the quantity of money or something like that, in the quantity of deposit accounts. Okay, I'm not using it in that way. When I talk about liquidity, it's very much in the finance way of thinking of liquidity, that it's market liquidity. And I make a distinction between funding liquidity and market liquidity. Market liquidity is the ability to buy or sell in volume without moving the price. Okay, and that is the suppliers of market liquidity are the dealers. Now, it's absolutely true that if they get scared and they stop making markets, market liquidity, poof, it just goes away. This is exactly right. Okay, that market liquidity is credit. It's an inside thing, and so it's not an outside thing. There's not like a positive quantity of it that is a stock somewhere that you can access. It's an inside character thing, and that makes it more elastic, both up and down. Understanding the economics of the dealer function, which is to say, what makes them stop making markets? Okay, it has to do with their position limits. It has to do with the outside spread, their ability to reduce their position limits when they want to without stopping trading, and that the economics of the dealer function is an attempt to think carefully about under what conditions they're going to supply liquidity and when they're not. I extend that to banks. So I start with dealers, and then I say, let's use that same framework now to talk about banks and their particular challenge, which is par, that they can't move the price around, and so they are more fragile, and so they rely on the central bank. They rely on whole mechanisms of refinance with banking networks and things like that, because they can't move the price. They expand their balance sheets much more. There's a lot more quantity adjustment than price adjustment. But that is the right question. Where is the vulnerability in this modern system? And the fact that liquidity is inside does mean that it is fragile. But it doesn't mean that there's no ways to support it. We're running in the last minutes now, so some voices that I haven't heard from.
Well, I'm curious about something
Yes, Patty.
from you. So, like about maybe 2004, and through that period where the housing market was really, really booming, did you have a sense that there was going to be a big crash?
2004. No, not really.
Not yet.
I will. So you're just asking my own sort of.
Well,
I'm 54 years old, and I've been teaching money and banking for 15 years, and I knew. I will tell you, I did know, and basically everyone who teaches money and banking knew this, that we were building this new kind of credit system that was, and people had different names for it, a parallel banking system, that it was definitely much more involved with capital markets, it was much more international. People had different views about this. We were building a new kind of credit system. And I told my class for a decade, I said, at some point this system will have a crash. Okay, it will be tested, and we will find out where it breaks. We don't know where it will break until it actually happens. In the summer of 2007, okay, I was actually sitting right here on Cape Cod, okay, in August, reading the Financial Times, and watching the spiking spreads between Eurodollar rates and Fed funds rates, okay, in the back page, going up to 100 basis points in August of 2007. And I was very sure that that meant that now we are testing this system, and we are going to find out where it breaks. So I saw it coming in that sense. Sort of in general, I knew that we were building a fragile system, and I saw it coming very specifically in August of 2007, okay, which is before it was really most people were paying attention. But I didn't know where it was going to break at all. It's a big, complicated system, and I certainly never thought it would be the worst recession since the Great Depression, or have such long-lasting effects as it's had. So I'm learning. I'm humbled by the experience of the last 5 years. I'm also exhilarated, actually, as a scholar. It's wonderful to be living through this real-life experiment, which throws up lots and lots of new data for us to understand how the system works. It's like a big hadron collider.
Laboratory. Yeah.
Yeah.
Oh, interesting. Thank you.
Um, so I think it's 12:30 now. So I don't want to make too long of a video here. So this is our first experiment, and I want to thank you all for taking part in this. My understanding is that this has been recorded, and so I'm going to post this on our course for other people to just have a look at. Hopefully, we'll get better at this and have some more of these. This wasn't really too hard. I think once I master this technology, we could do more of these things. You're all been such good sports, and I appreciate it. And I appreciate particularly, you're some of the most active people on the discussion forum. For those of you watching, this is what they look like. Okay, the people who are writing in every day. And you can aspire to this too. We can accommodate. This is a kind of technology that scales. So don't be afraid. Get in there in the discussion forum and participate. You see, they're just human beings. Okay. Thanks very much. I'm going to stop the broadcast now. I'm not sure if that will stop it for you 10 as well or not. We will find out. Here we go.